Hello, Face. Let's have a productive week. Have a lot going on this week. If you watch Blake's week ahead video, a lot of important numbers capped with the NFP on Friday. Hope everyone had a great weekend. I know you're not seeing my screen, so let's change it. Okay, so the bears are getting decimated. S&P bears, stock bears, equity bears, and this isn't as much of a victory lap as it is just a reminder that last week Greg came on and talked about this possibility. I came on and talked about my buddy Jim Welsh, who I've interviewed here, was looking for 28.15 and at least to take out this high. Blake's been talking about the seasonals being constructive. His chart of the day shows higher levels, I think back towards this 78.6 level. So the point I'm making is whether or not you got long or not, avoiding bad trades is just as important or even more so than being in winning trades, because you could have taken quite a sizable hit, especially with huge gap openings with the S&Ps coming in after the G20 news up 40. Okay, so just wanted to impress upon you guys here in Face that that was very valuable, but Face is only part of the picture. So there were a lot of great calls on the pattern in place. So you need to consider not just getting our analysis for an hour and then watching great interviews, but really immersing yourself in the markets, which you can do all on one site, with fundamentals being talked about all the way through on this stream, and takeaways if you don't want to spend a lot of time, and of course, what I consider to be unique in the business is having an expert in different methodologies, like Greg here and Andre here and Blake and Steve here, Blake and Steve here, and Stelios here. So you're really getting viewpoints from different methodologies. The cool part is when they're all saying the same thing, it's confluence of experts. So I'd consider at least taking the risk of a trial. It's $1, and check it out for 10 days. I'm betting you that buck that you won't want to be without it after 10 days. So let's just get back to the markets. The dollar didn't really, we had gap ups after G20 right here in Euro, but it wasn't much. And as Blake pointed out, and has been for a long time, how strong the commodity currencies have been, and talked about Aussie gapping up on the G20. You have to watch the week ahead video as part of your intelligence gathering. And I also want to comment, before I get to a few other markets, about what a great interview that was Friday. Do you guys agree? Everyone see Ronnie? Because my major takeaway is kind of what I suspected, because, you know, I'm uncomfortable if I'm not in the market and I can't find something to do. But here's a guy that's had tremendous, legendary success in the markets. And my key takeaway was when Ronnie said, you have to be willing to watch the market for days without trading until there's conditions are worth taking the risk. So it doesn't mean being away from the market, which is, you know, easier to do, and, you know, you don't have your platform on, you're not watching price action, you're out doing something else. He's saying you have to sit there and watch it. Okay, so, and I agree. I mean, you learn by not trading, by just getting a feel for price action, but you have to do the screen time. All right, everyone. I mean, especially in your formative years, you have to do the time so you're not caught in the crime of not being prepared to trade leverage markets. Okay, so Dixie's coming back. So I'm really not that impressed with Euro. I caught the rising wedge, and my confidence was shaken on the bull case after Friday. Pretty vicious, negated this formation, but it is possible, we're putting in, here's the first higher low, that this may end up being the second higher low. It also looks like it could, just wash. So, I'm going to watch a price action for a few days, and because right now it's not clear to me. The dollar was a little clearer earlier, at least last night. Again, just like the euro, you have your second lower high. So scalping this, wrong over this, not heavily, because I could also see the bull case that maybe we haven't finished, and the dollar is really not going to prove itself wrong until we take out this 96 level that Steve's been talking about for quite some time. So we're a whole handle above it, and plenty can happen in both directions. So still trading with a light touch. And even though the dollar weakness did not accelerate, you have very strong oil. Okay, maybe we get a pullback, but this is starting to look more and more like it might be a bottom. Watch pullbacks around the 52 level. And somewhat impressive is the precious metals, because they just kept gaining strength throughout the night. Gold's looking pretty good. A little aggravating to me because I got out of my nugget on Friday, and silver's outperforming gold by a long shot. Has anyone else noticed that you get these ghost trades every Sunday night in silver? It's like they take it lower, substantially sometimes, because, we closed in here, and then you blink and the candle's higher on the day. But I've been noticing this for weeks. Every Sunday night, it'll show these trades, although I don't see them on this wick, and then the next thing you know, silver is higher. So they're buying break. Silver's about to crack the 200 on the 4-hour. So it makes you think that you have to look for a falling dollar, but gold and silver actually acting very well. So we'll see if we can crack this. A lot of people waiting for 1240, 1237. We get through that, we have 1260, 1280 coming. Looking at how strong equities are, which I just showed you, I think you have to say that the yen is kind of muted. It came in higher. It too gapped higher up here last night, but so far, it sold off. I think this has a chance. If the metals are going to turn good for a C wave to the upside, the yen probably has a chance to sell off and this be a topping formation. So watching that as well. And I think that's really about it. I'm still watching Bitcoin. There were some pretty smart guys that thought that 4,000 might be a bottom. To me, it looks like we could probably wash one more time. I know a lot of people looking for 2,500 in Bitcoin. And then finally, just to check the yields out, which the yen also correlates to, that you would have thought, with risk on being as big as it is, we had this gap up in yields, but we're already coming off a little bit. So this is going to be important. I know Steve has shown the bonds. We did diverge down here under 3. And when I take a longer term look at this, it almost looks like this is corrective, and we're going to have another shot up in yields. So I actually favor that yields are going to bottom down here, and that we head up above 3.25 towards 336. You would think that would have a negative effect on euro, positive effect on the dollar. We'll see. So Blake, how are you, buddy? I know that
alive and kicking.
Okay, because I know George Bush, Herbert Walker was your commander when you were overseas, and he really did some amazing things, like get a coalition together of all those countries to push Saddam out. He also managed the end of the Cold War and the fall of the Berlin Wall, when a lot of the hawks wanted to really, stick it to the Soviet Union. It was a pretty peaceful transition. In fact, I think the German people call him like the father of the unified Germany. Which
it was so I guess I can tell you a couple. I'll tell you a couple quick stories really fast, since it's a little slow right now. But let's talk about number 41, President Bush. So when I first met him, I was in let me pull my screen here. I was in Somalia, and for those of you that don't know, I was in the infantry as a Marine, and I was in 3rd Battalion, 9th Marines, and only time I ever been shot at was in Mogadishu. Actually, it was Christmas night, 1992. But anyway, we were over there, and we were the first armed forces to go over there, and we had a very peaceful transition. We went in and took over Baidoa and Mogadishu, and took. I mean, if you saw like the weapons.
Lockdown.
What's that? No. This is 9 months beforehand. Okay. So it was. We took out all of the terrorist factions from those areas, so the United Nations could come in and feed the people, because these terrorist factions, what they were doing is they were cutting off the food supply to the people of Mogadishu. And so we had to, let me see if I can pull it up really quick. Mogadishu. Wow. So here's, let me pull up a map here. So we went in and took out, we were at Baidoa and Baidoa. So there's Baidoa here, and Baidoa should be right there. There's Baidoa. Where's Baidoa? Baidoa right here. So basically, we took out an area that looked like this, right here, and we took out this area and secured it. So we were basically getting all the terrorist factions out of the area. And if you saw like some of everything that we confiscated looked like straight out of the Road Warrior movie. Like if you ever seen Mad Max,
yeah,
all the vehicles that we confiscated look like that. RPGs and machine guns. And I was going house to house, just kind of going through every. We were going through every home and doing that. But anyway, so that took us about a month, and then we were done. We were on our way out, and as we were leaving, and we were at Mogadishu like for the week, we were just kind of waiting to get out of there, because the Army and the Australian Rangers took all of our posts. And the Marines were done. We went in, blazed a trail, we left. And as we were leaving, President Bush had come in, and I was assigned as one of his personal guards. So there was like, wow. Yeah, there's like 10 of us. And I was in a Humvee behind his motorcade. He had like a couple vehicles, and there was our Humvee, and then there was other. And I remember I was sitting there, and I got hit in the head with I want to say it was probably about a 15-pound rock. Hit me in the head. Unfortunately, I had my helmet on, just like clanked off my helmet and almost threw me off the back of the Hummer, because I was at the very back of the Humvee. And, afterwards, he was going back onto the, and into the airstrip, and he, shook our hands, and, I said, thank you. Anyway, so, years later, back in 2000, this is probably 2007, 2008, he was a speaker at our keynote speaker for our event, our Wise Trade event. And we were in the green room, because he had, I just got off a stage speaking to the traders, and then he was coming on like 30 minutes later, and so we're all in the green room, and he's got like 10 Secret Service agents back there, because he still had guard security guards around him at all times, as most former presidents do. And my son here, my oldest, he had his Hot Wheel cars, and he was hitting him in the feet. We were sitting at the same table. He kept like running out, and I turned to him and I said, I was like, President Bush, great to meet you again, and or great to see you again. He goes, see me again? When did I see you before? And I said, well, I was in Africa in 1993. He goes, oh, you were a Marine? I said, yes, sir, I was. And he said, he paused for a second, and he's like, thank you for your service. And I looked at him and I'm like, I don't know what to really say. So I sat there for a second. I'm like, well, thank you for your service. And he laughed, and then he went on stage, and he was a really inspiring speaker, and really classy gentleman.
Great story, man.
Yeah, super cool to hang out, or just to be in the back green room with him for probably like 10 minutes, and just hearing him talk and just interact with people. It's like I sat there and I'm like, man, I'm sitting back here with an American president, just shooting the crap. It's pretty cool. We did that with Colin Powell too. I've got a picture with Colin Powell, which
how about Schwarzkopf?
Schwarzkopf, I didn't get a chance to because I had to be. He actually spoke at our event too. Yeah, Storm and Norman did, but I was in a different part of the event. Yeah. We had Norman Schwarzkopf. We had a lot of speakers. We had Colin Powell, which I actually have a funny story about that, but I'm not going to tell you guys today. And then we had Apollo 13 crew. We had oh crap. Oh, we had Buzz Aldrich.
Wide Trade knew how to throw an event, didn't they?
They did. They used to throw, bring in keynote speakers, and it drew a lot of people. So Senator Bob Dole was awesome, so funny. Met him twice actually. So anyway, good stuff. But hey, let's talk about the markets here.
Good morning, Blake.
Blake, nice week ahead video too. Really prepped me.
Yeah, just wanted to say, as an outsider, I always found amazing that the first President Bush managed to have only one term, and his son managed to have two, because he was clearly, a much more competent person.
Yeah, I know, and that's as everybody will tell you, that's like a whole nother story. But anyway, yeah, I agree. I wasn't a big fan of his son. And as a Republican, I wasn't. But anyway, so the meetings over the weekend, the G20 meetings, they went well, and you had to expect that the meeting was going to go well. All right, and if you didn't, I mean, it's typical Trump affair that we would get a cheering of the event. He's going to walk away praising this and that and the other thing. What happens a week from now is a different story, or even a couple of days from now. So the market's gapped up. We saw the euro gap and rally, and now we've already filled the gap. We've already come in and filled the gap. The Aussie, and I picked up the Aussie at 50 overnight. So I actually jumped in the chat room, and I was in the middle of doing stuff. Yesterday I had to move 4,000 boxes for my wife's business yesterday. So I did it with you have a startup, and you do it on startup financing when you're bootstrapping a business. So physically I'm like, well, I need the workout anyway. So yeah, I was really tired yesterday, but I jumped in the chat room and said, I'm buying the Aussie dollar at 50, and I picked it up right at the lows, and I like the Aussie. I think the Aussie's, it's going to continue to stay well bid, and I actually like the the stock market, and I think it's going to continue to be strong. The only problem with the equity markets is that we stopped at the 618 retracement, which is, obviously a significant, retracement level. Key resistance, we stopped at on a dime in European trade. You can see it right here, and we're probably going to come off a little bit. I mean, but I would expect that dips are going to be fairly light. We are into the season of the Santa Claus rally season, right? And I would expect that there are buyers on dips now. So now how far we dip in the S&P, I mean, we might dip another 20 S&P points, maybe 50. I mean, we're up right now 35 as far as my futures go. S&P futures are up 40 points. I mean, we may give back some of those gains this morning, but I would expect buyers to be on dips now because the market's going to be chasing yield going into the end of the year. If they don't, you look at the macro picture and you're like, okay, well, we're on hold with the China U.S. Trade spitball fight that we've got going on. They're going to be in a negotiating process over the next 2 months or 3 months, and you don't know how it's going to turn out. And frankly, I think it's going to turn out for the worse. If I had to guess, if I had to guess that neither China nor us is going to budge, but in the near term, people look around and go, okay, I don't have any other choice. What am I going to do? If I don't plow into the markets now, and I don't show that as a fund manager,
great point,
is if I haven't shown that I'm active and I'm getting long the markets and getting in, and I'm gonna get redemptions at the end of the year, or the beginning of the year. I'm gonna have, I'm not gonna, if I'm managing, $1 billion right now, I'm probably going to end up managing about a $500 million because I'm going to have a lot of redemption. So I need to show that I'm, active in the markets as a CTA, and I'm taking advantage of the markets. And this is a green light, at least going into the end of the year. Like I said, I don't necessarily believe that this stall in trade talks is going to yield something more positive in the future. I probably believe in February we're going to increase tariffs to 25%, and this is going to start once again. That's why I think that the S&P, you got to be nimble, but I think that dips will be bought, and then we're going to rally into year end, and somewhere up here we're probably going to sell off going into the beginning of the year, first month or two in the year. I mean, if I had to just take a stab and try to look at my crystal ball. But so what I'm trying to say is I would be more apt to be long risk, not necessarily at this moment in time, but if we get a dip here in the next day or two, I think being long risk is the way to go. Now you look at other things too. It's not just you go to the S&P and look at that. I mean, look at crude. There's a lot of headlines over the weekend regarding output. Crude actually broke this down channel. I know Steve is getting long crude. At these levels, and I think that crude at any dip down to $52 is probably a place you want to be long. I mean, it doesn't mean you have to just run out and buy it right now. I think if you buy it right now, close your eyes and hope for the best over the course of the next couple of weeks, you're going to, do well. But I think there's going to be better places to be long, like somewhere down here, somewhere down, in this case, maybe close to a 200 period moving average on the hourly. But that's not necessarily what I'm looking at. I'm just saying if I had to guess, it's going to be somewhere down here. But there are. You look at the Aussie, and the Aussie looks like it is going to squeeze. I mean, we are gapping higher. We got the 200-day right here, and it looks like the Aussie is probably heading up to 75, maybe even 76 cents. I mean, if we completed this double top for the most part, had the whole market short, so now the market's retracing and move up to 76 or 77 cents does not beyond the realm of possibilities at this point. Again, are there going to be better places to enter? in the Aussie? Maybe. I bought it at 50. We're at 80 now. You know, are you going to be able to buy it back at, you know, below 70, you know, 70, 350 today? Maybe. But I would be taking advantage of that. I'd be looking for dips to be a buyer now. And so that's really the way I would approach the market. Now, the cable I'm still leaving alone. And you look at the cable, it's trading so heavy. And I haven't even looked at the, you know, what the news has been regarding the pound. But, you know, obviously until next week, there's just no reason, in my opinion, to be long the cable at this moment. You know, we have to have some sort of indication that there's, without a shadow of a doubt, it's going to pass through Parliament next Tuesday. And, you know, that might even be a day or two ahead of the vote because of the indications that we're getting. But until that happens, I'm not getting long the cable. And I'll tell you who's been on it, Amanda in our chat room. Amanda Sweeney, she's been just ripping up the cable to shreds. Any rally, she just pounds the crap out of it, and that's been the right call, and she's been nailing it. And so well done, Amanda. And but as far as the rest of them, like the euro, like I'm buying dips. I've picked it up. I picked it up at 25 this morning, scalped out of it at 35. I bought it again here at 34. I just bought a little bit more down below in the 20s, just picking up because I think the euro is going to eventually, you know, trade back up, you know, towards 114. Doesn't mean I'm going to hang on to it today, tomorrow, and the next day from here, but I'm just trying to buy dips and then, you know, sell rallies until I have a better indication that the dollar's ready to go. But you look at gold's stronger, silver's hitting new highs on the day. So, you know, these are the places you want to be right now.
I was going to ask you if your view on gold and if we breached any significant areas in either gold or silver.
You know, you look at gold and we broke this triangle, so you know that's positive. Now, but gold still has to breach 1240 or 1242. This is, remember, this is that big previous support. Previous support acting as resistance. So yeah, I mean, it looks like we're constructive here. So I wouldn't want to be short. How about that? You know, I may not be long, but I sure as hell wouldn't want to be short. And there's a lot of I think there's a lot of things that are pointing towards dollar weakness right now, minus the cable. I just don't want to even touch the cable at this moment. But you look at the Aussie dollar and the Kiwi, they look strong. The dollar Canadian looks extremely weak. Crude looks like it's rallying. The US dollar Norwegian krona is rolling over. I mean, these are all, you know, just, I think the dollar is a sell on rallies at this point, minus the cable. The cable are just kind of, you know, on its own program, and you want to buy some of these yen pairs. So that, you know, if you watch the week ahead video, my plan hasn't changed, and I'm still, that's the way I'm trading. So hopefully, and again about this the interview last Friday. Thank you, Coach. I'm glad that you enjoyed it. And I hope I got a lot of people that really enjoyed it. If you hadn't had an opportunity to listen to that, make sure you go to our website and listen to that interview with Ronnie Schlapfer. He's an amazing person and really a legend when it comes to the markets.
I tweeted that you did a great job as an interviewer, and I'm glad you don't want to do everything.
Yeah. Thanks, Coach. I appreciate that. No need for me to do it. You're too good at it. So, but as far as Ronnie goes, I had to do that one.
Great job, man.
Thank you. I appreciate it. All right. Well, Steve, Celios, Coach, you guys, good luck. Thank you guys, and good luck to the rest of you guys. I'll see you guys tomorrow.
Okay, buddy. Yeah, buddy.
I don't know if you know. I know that you didn't remember, but Blake has interviewed me as well before you did.
Oh, yeah.
Yeah, so I've been
at Wise Trade.
Yeah.
Oh, okay, yeah. I know he was starting to do interviews after I met him, but I guess he's been doing it, you know.
He was doing
forever.
it on occasion. Yeah, but on occasion.
I've done interviews on occasion for 15 years. Yeah. So,
yeah.
All right, I gotta go. Bye.
I probably bet you were his most memorable guest. Because look at what happened.
You
converted it into a partnership. Nice going, man. Huh?
He was It was probably the most memorable guest because he didn't let him say a word, right?
No, it was mostly during still the European crisis, so we were focusing mostly on the tail risk of Greece and the whole situation. So I have to say that we were our conversations were mostly back then on a fundamental basis because we had ongoing developments in the eurozone. So it
Wow,
was mostly
Steve,
about
that gold silver ratio chart looks like we're putting in a key day here today.
Yeah, exactly. I wanted to start by that because not only first, of course, they slammed silver today, and I'm going to show the silver chart, but look now what we have in the gold silver ratio, right? Let's have a look at here what we got. We got a huge spike higher. We got a very, very clearly double divergence, or what you like to call a three drive formation, right? So I think today, if we close like this, and especially if we make it below this 85 zone, that's going to be a huge, huge reversal for the gold silver ratio. So I think that this is one trade that starts looking extremely, extremely appealing. And as I've explained, of course, you're not going to find anywhere in your broker how to do that, but you can make it by building a synthetic trade, right? So you can be concurrently the same amount of money, long silver and short gold, both of them against the dollar. So this way you synthetically build a long silver, short gold position. So I'm really, really interested to see how the day is going to close. But so far, this looks very, very appealing. So let's see what kind of a daily close we get. Now, having to do with silver, just look at this. Stelio, this is not a surprise, right? Early slump down to previous support. Actually, we almost made it to new lows. I believe that they probably wanted to get us to new lows.
I've been seeing those ghost spikes every Sunday night. They'll take it down. Have you guys been noticing it? But it sure doesn't trade there. I mean, I don't see a trade there for more. I
need to remind you that they've already caught plenty of banks and traders that have admitted to manipulating precious metals. So that's already a given. We know that. And second of all, you don't need to be a conspiracy theorist or whatever. Just tell me, how many times have you seen huge spikes in gold and silver during illiquid markets? And
every Sunday night in silver the last month or so. I go, well, when did that happen?
How many times were they on the upside?
Exactly. How many of those were there to the upside? I can't remember any. None. I mean, if you go back to a chart, you can see many weird activities. I mean, who would want to dump a big position at an illiquid market
on Sunday night?
Yeah, exactly. Or like, Asian hours, sometimes in the middle of the week, like, when there's not much happening or whatever. So if somebody wants to genuinely, offload a position, you will do it during liquid hours. You will do it, part by part. You're not going to dump it at the most liquid hour to move the market like, $0.50 or $1 just out of nowhere. So silver went down, retested this low. So, it even has the potential of a triple bottom now. Of course, as I said, this is simply a potential because this remains a descending triangle. A descending triangle can break either way. Statistics that have been run on stocks, because I'm not aware of statistics that have been run on FX on these kind of patterns, have shown that in the vast majority of the cases, the break is in the direction of the trend in such a case. So it's still a higher likelihood that it's going to break lower. But if it does happen to break higher, and if we do happen to close on a daily closing basis above 1480, then we're going to be talking about a different kind of formation, and that's going to be actually a triple bottom formation, in which case the target is going to be rather simple. It's going to be, if we take this length and we project it, let's say from 1480, that's going to be roughly taking us back to 1580, right? So it's a $1 range, and then we will be talking about a bigger rebound. Now, at the same time, gold is indeed finally breaking after so many tests of this descending trendline resistance. Gold is finally breaking, but of course we need to get a verification on a daily closing basis, but it looks rather likely that it's going to happen. It's finally breaking above this trend line, in which case now we have a very, very good case of double zigzag and the possibility of a push higher towards this nice confluence of resistances at 1260. That's the 50% fib of the last move lower. Also, it's going to be the nice channeled corrective channels resistance. So, this is what we drew last week, that we either break below, this ascending channel and this horizontal support area, and then we move to new low straight from there, or we break above this trend line resistance, in which case I do think that the correction is going to have one more leg left to run before we can move lower. Equivalently, I think that the chances that this is the beginning of this correction in crude has increased. I actually bought yesterday night. I bought crude, I wrote it in the chat room as well, at 52.60. And just before the webinar, when we had dipped down to 52.87, I wrote in the chat room again that I'm increasing my position to a half position because I think that's a decent retracement. So now I'm running a half a position with a cost average of roughly 52.70. And I do think that it's a quite nice possibility that we will eventually make it to a corrective bounce towards perhaps this support resistance area at 58, 50, 58.70, somewhere there. So we drew that last week, and I still like it very, very much. Unfortunately, I had established a position from that low, but got knocked out on Friday on that spike low, literally at break even. I mean, I literally on the peep I got knocked out. Otherwise, unfortunately, I would have had a position from a much better cost average, but I didn't care, because once I saw the price action yesterday, I jumped on it again, because I do think that this RSI divergence, this extremely oversold move lower, is bound for at least some kind of a corrective price action. So I had no problem jumping back in, and I will have no problem adding to my position and bringing it up to a full position. I want to see how we close the day, if we get another retracement, etc. Gold, crude look like they've opened the door for at least one leg higher. Silver hasn't done it yet, but as I said, the price action that we've seen so far today, opens the possibility of some kind of a bottoming formation as well for a big rebound higher. Now, what we see here in the Aussie is the definition of what we call, at least if we don't close the gap by the end of the day or tomorrow, this is the definition of a breakaway gap, because this was clearly a support resistance area. And, the fact that we gapped higher, we didn't manage to close the gap, and the possibility that we're going to run higher towards 75 look quite decent to me. So this is a breakaway gap in this case. And, more or less the same is the situation here with the Kiwi. Kiwi was finding resistance in this horizontal support resistance area. The 200 DMA was there as well. We did the exact same thing. So I do think that both of them look decent for one more leg higher, even if that still proves to be part of a corrective move. Now, what is definitely not looking good, and I've kept saying that over and over and over again, is cable. Cable is now testing this symmetrical triangles support. So if I had to be long US dollar against one currency, that would, without doubt, from the popular ones, I mean, right? That would, without doubt, be the pound. I do think, and as I've been saying, that this triangle has a very high chance of getting resolved to the downside. On the other hand, euros shows quite a lot more resilience. And this is the reason, in combination with how the technical outlook is, that I believe that it's quite likely that we're going to have another run higher in the euro pound. We drew that several days ago. It looks like we're making another attempt to break above this confluence of resistances at 89.30. I believe it's a decent chance that we're going to make this move and then push higher once again in the euro pound. I believe that a daily close above 89.30 is more or less going to confirm the beginning of such a move. This candle higher was indicative. I view this as a consolidation after a big move higher, and I do believe that the next move is going to be higher as well, breaking above the descending channel and the 61.8 and confirming that, there is more left to the upside. Now, USD Swiss, in my opinion, it still looks good for one more leg lower. So I remain in this pair. I still maintain my position here. RSI divergence, broken wedge. So even if it's for a corrective move, I do like it here. And in fact, I do think that having retested that parity level already 3 times and failed from that, that was a nice entry level as well for whoever wasn't involved, as long as you understand, obviously, always the risk and reward of the situation, because as a trader, that's the only thing you can control, right? Now, having to do with USD yen, first of all, let's say that USD yen is still coiling here. It's more than obvious that the next move is going to come either when we breach through this descending intermittent red trend line, in which case I will be looking for one more leg higher towards this 116 area, 115.50, 116 area before lower. Otherwise, if we do close below 113, I think we go straight lower from there. So more or less, the situation with USD yen is what the situation with gold was. I mean, gold was trapped between this ascending trend line. In that case, though, it was the channel support, and that intermittent descending trend line resistance. More or less, it's the same technical picture here. So whatever of the two gives way, I think we're going to see some follow through. Until that happens, personally, I wouldn't do anything about it. Now, having to do with the dollar, dollar index is holding still within this ascending channel, but really very unimpressive momentum. Not impossible to see one more thrust higher, but personally, I do believe that there is a good chance that it's simply going to fail from here, and a move below 96.20 and the daily close at around 96 is going to confirm such a view. Now, having to do with stocks, personally, I see all the fuss and happiness, and I know that seasonality indicates, and coach, you've said it very, very, very well in the past. How did you say it, that bears feast in Thanksgiving and bulls?
Right. Yeah.
Yeah. At Christmas, right?
The bull. Yeah, that's right.
Yeah.
They both eat on different holidays. Yeah.
Yes. So seasonality would suggest that would be a lovely area, a lovely place for us to move higher and perhaps move to new highs, because I've said many, many times, we have to respect that the trend remains higher. There's no question about it. We haven't even managed in the long term to post like a lower low. Don't forget that the most important indication for a trend is at an uptrend, you want to see higher lows. In a downtrend, you want to see lower highs, right? But I'm still of the opinion that I would very, very gladly see this 61.8 break to the upside. A lot of people will be talking about a double bottom formation then, pointing to new highs, and that might as well be the case. But personally, I would be looking to build a short position as we get close to the 78.6, because I think that the market can really get caught off guard here. Everybody turning bullish, thinking that this correction is over. It might be, but I think that the risk-reward ratio would be extremely favorable for me to make another. I've already made like 4 trades in the S&P, and one of them was even to the long side, and all of them, have yielded results since we were up here. I have no problem making one more attempt to the downside. If it doesn't work, fine. I'll have a very clearly defined risk-reward ratio. But personally, I'm not yet buying into this enthusiasm here. Now, I'm not saying that we're going to fail from this 61.8 and create another failed attempt at this area. Although if we go down to the 4-hour chart, and I did post that earlier in European hours, as you see, in the short term, we were really overbought and we were at a confluence of resistances. So a little pullback from here is something you should expect. But I do believe that we might push higher from here, and I do think that might prove to be initially a bull trap, because I do think that the chances that the corrective move lower has more to run are decently high. So I will stick to my initial plan. I want to be short close to 28.70, and if I'm wrong, I'm going to be risking not much. If I'm right, I think we're going to see a sharp move to the downside, getting everybody off guard, because I see a lot of sentiment. I see a very, very fast change of sentiment even by looking at my Twitter feed, and that's something that I really like. I mean, it really benefits my view on that. Now, having to do with USD NOK, obviously USD NOK, and I'm mentioning this because it's strongly correlated to crude as well. USD NOK got rejected once again from this horizontal support resistance area, but still holds this ascending trend line. I would still be careful here because we've broken above this large formation. So I would be careful. We might find support here at 840 something. I wouldn't still be jumping the gun here, despite also seeing this RSI divergence, because on one hand, I'm seeing RSI divergence. On the other hand, I'm not seeing RSI really deep lower. So USD NOK still giving me mixed signals. I'm mentioning that because I saw somebody mentioning it in the chat room as well. I don't remember. Another interesting trade to watch here is CAD yen, and the reason I'm saying that is because CAD yen once again found support here, and shows some it's already created a gap which it hasn't been filled. So I'm keeping an eye on that, not intending to trade it, but it certainly looks interesting that last week it was looking like the week before actually that we would actually break below, which was my main case scenario. But as it seems, it's still holding into this formation. Equivalently, USD CAD has made a move lower, but in this case, we did have a technical situation. I mean, we did break below this ascending channel. What I would want to see, though, to believe more in the bearish scenario here in the USD CAD is what it's going to do when it retests this broken trend line, which was parallel to this one, right? So yes, we already have an event here. So it looks like the USD CAD wants to correct lower, but I don't think that it's a slam dunk short for, like in the medium term. It might be to the short term yet. Anyhow, if you are already short the USD CAD, so far so good. It looks good. We didn't manage to close the gap as well, so it does look that in the short term it can produce more weakness. Now, I know that a lot of people are monitoring and a lot of people are trying to bottom pick Euro Aussie, Euro Kiwi, Pound Aussie, and Pound Kiwi. What I see in all of them is very fatigued trends. I see very clear 5 waves down. So yes, I'm on board with this kind of thinking. I'm on board with the idea that Euro Aussie, Euro Kiwi, Pound Aussie, and Pound Kiwi will soon produce a corrective move higher, but don't forget that they tend to be quite volatile pairs. So I would first want to see some kind of a short-term indication, like a reversal candle or a reversal short-term pattern, before I started buying them. So although I do like the idea of seeing a rebound unfold sooner rather than later, and that might happen, for example, with at the same time, because we know that they're inversely correlated with risk usually, that might happen at the same time that we might see a rejection from risky assets. For example, as I said, with the S&P at the 78.6. But I would caution that until then, you need to be rather careful and make sure that you take into account when you build in positions, when you build in position in those pairs, make sure you take into account the ATR, because usually the average true range of these pairs tends to be a lot higher than, let's say, at for cable, for Euro USD, etc. So there are some people that are conditioned to be, let's say, buying or selling the same amount of dollars or whatever the currency you're trading with is, regardless of what kind of pair they're trading. But I would strongly suggest that you should, let's say, adjust your position size according to the volatility of the pair you're going to be trading. So, going with the same position size in Euro USD and Euro Aussie, if you have the same conviction, doesn't make much sense because you don't really adjust for volatility, right? That's why I said the best indicator of volatility, in my opinion, especially in FX, is the ATR, the average true range. There is every single charting package has an ATR, so that gives you an idea what's the average range during X number of periods, so you know what to expect that the average movement is going to be. So then you can go ahead and compare it with Euro USD, and you can understand, for example, get as a rules of thumb, eyeball more or less, how much you should adjust your entry size. So Euro Aussie gapped lower. So far, a shooting star. That's quite a bearish candle, especially given the fact that we didn't close the gap. We actually gapped lower. This is called, by the way, since we were already running late, this is called the runaway gap. We gapped lower from a horizontal support area, so we actually didn't. I mean, we stopped there on Friday, and we simply gapped lower from there. And the next area of support is this previous low at 152.75. If we have a look at the Euro Kiwi, you will see the same deal here, and that's what I drew last week in the Euro Kiwi, that perhaps there is one more move to the downside before seeing a correction higher, and that's what we are doing at the moment. Nice confluence of supports here, roughly at 162.30. Very clear 5-wave pattern as well here. 1, 2, 3, 4, 5, right? So this is likely an A from a zigzag, from an ABC, right? Because A and C in a zigzag are impulsive waves. So the fact that we have 5 waves down doesn't mean that the trend, the big trend, the longer trend has changed. It just means that, after we bounce, we should see at least one more leg lower. That's all it means, right? So I would expect at some point very soon for a rebound to unfold from here, and that should produce then one more leg lower. I do think that the risk-reward ratio does not favor any more shorting here. If you wanted to be short, you could short these flag patterns. If you go down to a 4-hour chart, you will see that all those pairs were actually creating nice pennants or flags, and then that was a good entry. But now, if you want to do something with those pairs, I suggest that you first wait for a big rebound, and once you see this rebound faltering, then look for a nice trading opportunity to the downside again. Now, Pound Aussie and Pound Kiwi also trading. Pound Aussie also trading within this descending channel, pushing towards the next area of support, which is a little bit below 171. Same situation here, roughly at 171. We're going to have a confluence of this horizontal support area and this descending channel. You might be looking for a rebound from here, but as I said, best thing you can do is wait for a rebound, wait for that rebound to start faltering, and then look for one more leg lower. Pound Kiwi doesn't look much different than that. Actually, this is what we drew last week, another very, very clear corrective move higher, found resistance at previous support, now pushing towards a zone that is full of support and support and previous resistance levels. So I would be looking for a rebound sooner rather than later in this one as well. Same drill here. Rather wait for a rebound to unfold and then look to be short the next move lower than anything else. Now let me go ahead and have a look at the questions. We might get some ideas from there. Love the interview. That's they say, guys, I don't see the spikes at low in IB. Yeah, Costa, yeah, it might be, it might be broker related. Check it out in Bloomberg and let me know, Costa. Natural gas, sure. Let's have a look at it. Okay, natural gas. There it is. So let's have a look at the long-term picture. Last time we had a look at it before the big spike was here, and I had said that, listen, natural gas seems to be coiling between this horizontal support area and this descending trend line. We had one more move higher, so my intuition told me that we should have at least one more move higher. Obviously, I didn't expect that move higher would have that kind of a volatility, that kind of a spike. I mean, the daily RSI literally hit levels above 90. Now, this seems like a consolidation to me, like a triangle, so I wouldn't be surprised if natural gas has one more leg higher to produce before lower, okay? So if I had to bet on what's going to happen in natural gas, I would be expecting after a period of a consolidation, perhaps in this triangle, one more spike higher before perhaps lower or a lot lower, because that might have been, after that might have been the move, right? Like an A, B, C, right? B being a triangle. So that's what I think about natural gas. So I wouldn't be shorting it yet. I have to tell you that because this looks like a triangle to me. But I would be quite tempted to short a spike that will fail above this triangle. Okay, I think that's the best play. Please cover exotics as well and how the G20 meeting will affect emerging markets. Thank you. It remains to be seen, but I do think that we're going to have some dollar weakness for some reason, especially as long as there are hopes that there will be, there will be a deal with China. For some reason, in my opinion, completely mistakenly, but it doesn't matter because the market can be mistaken for a long period of time until it lands back to reality. The market was considering that the trade war was bullish for the dollar. In my opinion, long-term, fundamentally speaking, that was not the case, but it doesn't matter because, you have to go with the flow and, as long as the market buys into that story, it's fine. So now we might see some dollar weakness, and that's definitely going to help at the exotics. Okay.
Look at the Steve, also this wand chart that you're showing.
Exactly. That's why I opened this first.
A lot of people connect the correlation between gold and the won, that there's almost like a won gold peg. So lower action in USD1 is supportive for the gold move.
Exactly, and look where it opened today and what it's doing now. It's currently testing this ascending trend line. So either of these two would happen, and I do believe that if we actually do close below this ascending trend line, we will see some follow through. So yes, that would bode well, coach, with that move higher in gold that I said that if we confirm today on the daily close, the close on gold above that descending intermittent trend line resistance, then we should see gold appreciating towards 1260 and USD yuan if it does that move. And in general, that's going to end up affecting equivalently the vast majority of exotic pairs and exotic currencies. I know we're running out of time, so I'm going to have a more detailed
We're really
view
not,
of-
Steve. There seems to be a mix-up. There seems to be a mix-up. I've been trying to reach Chris Capri. He thinks that the interview is at a half an hour from now, and I've been sending him messages for about 20 minutes. I still haven't heard from him.
Okay.
Yeah, I don't know
okay.
why. I don't know why he thought it was that time, but I've been trying to
It's
reach.
okay. So we have more time to show a few more things.
Yeah.
It's absolutely okay. So
We'll see.
let's go ahead and have a look at this. USDMXN, first of all. USDMXN was an amazing trade. I said it last week as well. Blake was all over it, from what I know. A very, very clear three drive formation here, coach, right? And break lower from here, a retest. And today's price action clearly shows continuation. So USDMXN to the downside looks, quite compelling. USDZAR, USDZAR, can move lower from here, but I don't like this price action because so far it looks more correct. Yeah, it's a grinder, and that's not what you want to see in this case. USD actually TRY dumping today. USD Ruble, in my opinion, USD Ruble probably a nice trade as well, especially if we see this rebound higher in crude that I expect is likely, because I drew this as you see, it looks like a nice potential for one more leg lower, right? So like an ABC or whatever here. So this looks quite appealing as well. I forgot to mention a few more of the palladium pushing as we had expected, pushing above this triangle, but I would start getting very, very cautious here because this is now quite a prolonged uptrend. We are also approaching the 127% extension from this whole corrective move lower. So I would expect that a bigger correction to the downside might start sooner rather than later. And copper, I don't want to forget to mention copper because copper has spent a long period of time creating this triangle. Triangles tend to break to the downside. That's why I said that I also expect that silver has a higher chance of breaking the downside, but that doesn't mean that they can't break to the other direction, right? It just means that statistically, they tend to break more often to the other direction, which means be very careful here with copper because copper is retesting this trend line, and this trend line has already been tested 4 times from the market. And as you know, the longer a trend line has proves its value, the more the tests, the higher the probability that once you break above it, there is going to be follow through. So in this case,
kind of plays in with the S&Ps perhaps getting up towards that 2870 level. That would be supportive of copper.
Yeah.
Did Steve, did you show your silver chart yet? Did we have a false breakdown? Did you
no,
show
we didn't,
that?
but we had a false.
Yeah, you showed it. You showed it. Yeah. Okay.
We had a false retest of the lows. Yes.
Okay.
Yes.
Because you had a triangle breakdown, I think, last week. You had it in a triangle.
We made it. No. This is a triangle. This is a descending triangle, as you know, coach.
Okay.
Yes.
Okay. Thank you.
So we've already tested 3 times this, 3-4 times, depends on how you draw it. If you draw it as a zone, we've actually tested multiple times this triangles, bottom trend line, horizontal trend line. So but big outside white candle, very big outside white candle. Okay. So let's see how we close. And as I said, if we close above 1480, that's going to be a big
1550, maybe. Huh?
1560 at the very minimum, in my opinion.
Okay.
1560 at the very minimum, which is 50% fib of the last move lower. Now,
and it's interesting the metals are doing this without a real weak dollar, don't you think?
Yeah,
I mean, euro's
dollar,
not strong.
Yeah,
Aussie.
Yeah, something though, and I keep repeating that to people. The DXY, which is the traditional dollar index, don't forget that it has only 5 components in it. It has the euro, it has the pound, it has the yen, it has the SEK, many people don't know it, but part of the DXY is the SEC, I think 4 point something %, and it has the Swiss franc as well, 3 point something %, if I remember right. So USD, if you consider especially that USD Swiss is almost inversely correlated, so in essence, having to do with the dollar side, because it's inversely correlated, just because the USD Swiss, we call it with the USD being the base currency and not the quote currency. But if you quote it as CHF USD, it's almost perfectly correlated the vast majority of the times with Euro USD, and you add Euro USD with CHF USD, that brings in total the two of them composing 61% of the DXY, which literally means that the DXY can move in that one direction just by Euro being weak or strong, right? And the rest of the things not doing more or less anything. So also don't forget that the traditional DXY, you don't really have commodity currencies in it at all, which is skews quite a lot the behavior of the index. So what we're seeing today is dollar being weak against commodity currencies and holding its ground against everything else. So I think that in occasions like this, you should not let the DXY confuse you, simply because we are seeing a market that gives you the ability for the moment to be both short and long the dollar against different currencies, and maybe being able to make money, in either case, right?
Yes, buddy. So I still can't raise Chris.
Okay. So
we'll have to reschedule.
Oh yeah, Stephen corrects me. He's right about it. It also has the CAD, which is the only commodity currency it has. On the other hand, CAD is quite more strongly correlated to the US economy. So, it is a commodity currency. I forgot about it. Yeah, it's the last component. It is a commodity currency, but it's the one that's closest correlated to USD. So, yeah, thank you, Stephen. By the way, the Federal Reserve, many people don't know it, the Federal Reserve also has two more dollar indexes that are trade balanced. I mean, they're balanced most by having to do with the US trade partners. One of them, for example, has the Aussie. The other one even has the Chinese yuan, the MXN. But those ones, nobody looks at. I'm just, giving it as a, irrelevant information of the day. Also, there is, which is quite decent, there is an index from FXCM which you can monitor, which is called the US dollar index. This one.
People use that one.
Yes, which is more evenly balanced between currencies. So this one includes the Aussie and some few, I think the Kiwi, etc. So you see,
it looks thinly traded compared to the Dixie.
Yeah. Of course. Yeah. But as you see, it's there is a clear loss of momentum here, right? I mean, just look. The daily RSI has been diverging since the beginning of May here. So
that's a long time.
This is that's a very, very long time, and eventually something has to give, right?
Yeah. Either blows off and blows out the divergence, or rolls
exactly as you mentioned. Yes, correct. Okay, so I do think that we're going to have an interesting week ahead, and that's good news for us traders, because you do want to see volatility. You do want to see nice moves, because nice moves and volatility help clarify the technical picture. So these are the times that you should be stepping on the metal, and not times that you have really choppy markets and you're just, don't have the patience from sitting on your hands. Don't forget that discipline and waiting for the trade to come to you, for the market to come to you, is probably the one characteristic that the vast majority of successful traders, that and money management, have in common, right?
Yeah, Ronnie sure drove that home.
Yeah.
And he said very few people could sit and watch the market and not trade, and that's what you have to do.
Exactly. Exactly. And if you read the vast majority of the technical books, that's what they tell you as well. That your worst enemy is yourself. And why is it yourself? Because the human psychology is such that if you sit all the day in front of 4 computer screens, 2 computer screens, 10, doesn't really matter how many, at some point, you subconsciously try to find things that look better than they actually look, because the human brain works a lot in a comparative basis. So let's say that you have 10 things in front of you, and 8 of them look bad, 1 of them looks so and so, and 1 of them looks somewhat promising. You're going to start believing that the one that looks somewhat promising looks good, because in comparison to the rest, it looks good. You know what I mean? But that doesn't mean that it looks good enough for you to jump on it. So there are periods of time that you'd rather do nothing. And unfortunately, this kind of human behavior has been recognized, has been confirmed on all fields. Just to give you an example.
Well, I could give a live example, Steve. I was long nugget.
I'm gonna give you an example that's actually scary. They've run a test that they took 1,000 kids and took them through a committee of doctors to determine if they should have their tonsils removed. So after examining 1,000 kids, the committee of doctors decided that the next percentage of the kids, like I think it was like 30-40%, something like that, needed tonsil removal. So then they took the kids that the committee of doctors decided that they don't need tonsil removal, and they took them through a second committee of doctors that were completely unaware, of what had happened before. So they took the kids that they didn't need tonsil removal according to the first committee, and they took them to the second committee and told them to examine them, that to say if they need tonsil removal. So the second committee found plus or minus 2% that the same percentage of kids of what was left over needed tonsil removal. Then they took the kids that none of the 2 committees had decided that they need tonsil removal, and they took them through a third committee. And that third committee, plus or minus 2%, decided that the same percentage of kids that were left over needed tonsil removal. You understand what I mean? So when you take in front of a doctor, let's say 100 kids, and you tell him, tell me which of those need tonsil removal, the first thing he's going to think is like, okay, statistically speaking, some of them do. So, then he starts working on a comparative basis. Which tonsils look better and which worse? So that's the same mistake we're doing as traders often. You know what I mean?
Yep. And even veteran traders make mistake. I was long nugget from the low on, I don't know, Wednesday and Thursday, and decided to get out of the way on Friday, and it's going to be sharply higher today. So,
I have a request, by the way, since we have the time. I have a request for DAX, and thank you for reminding me, because DAX, and I completely forgot to mention it, DAX is at the first important level, and I'm going to explain why I say the first. It's the first because here we also had the possibility, not the possibility, this was clearly a descending triangle. So we're testing now this confluence of the descending triangles resistance and this horizontal support resistance area. So if we do break above that, then the only level that's left over is the neckline of the broken neckline of the head and shoulders formation, which should prove to be a tough resistance to crack. Now, what's the interesting part here is the following. If we break above here and we make it there, then you are left with 2 and only 2 possible interpretations. Interpretation number 1, we get rejected from here, so then it's a classic breakdown, retest, and move lower situation. Or we break above the broken neckline, in which case 2 things happen concurrently. 1, you have a double bottom getting triggered, which is bullish, and 2, you get a very large bearish formation invalidated as well, which on itself is also bullish. So simply put, the key level is up here, 11,800 to 11,850. If we break above that, then from being bearish, you have to completely turn being bullish for the two reasons I just mentioned. FTSE, more or less the same situation, not as clear as the DAX. Possibility of a triangle here, but don't forget that in a correction you can never know because the triangle might be this, right? I mean, you can't be certain exactly what kind of triangle we're talking about, but possibility of a triangle. So I'm monitoring this to begin with. Also a possibility of a double bottom here, right? Here and here. Of course, for this double bottom to get triggered, we need to go a lot higher. Regardless, so far we've failed in this retest of this trend line. Let's see what happens later today. But I do think that, and something else, so I don't forget, Nikkei, two possibilities here as well, and you can see it very, very clearly. Possibility number one, this was an ABC, which will perfectly retest once again this broken trend line support as resistance, and then lower. So this is a key juncture, right? So from a risk reward perspective, I think that the Nikkei is a good, it's a good option if you want to be short risk somewhere. The Nikkei looks at a great point because you know where you're wrong, right? And it's not far away. So, Coach, what did you want to say?
Oh, I mean, Chris will be here most likely in 15 minutes if you want to continue or reschedule your call.
Sure, 15 minutes. Okay. Well, I'm monitoring like 50, 60 markets. I'll find something to begin with.
I know. I figured that, look, what does Steve really like to do more than almost anything else professionally? And that's to talk about the markets. So I figured you could fill it in, bro.
By the way, look what we've done here. You remember the last time we checked that, right?
Yeah.
The emerging market. Look where we currently are, right?
Yeah.
Retesting
on the verge of a breakout.
Yeah, on the verge. Yeah. So quite an important level here.
That was a great call near the lows, buddy.
Thank you. And the FXI, as you see, not coincidentally,
yeah,
the FXI
okay.
Also almost, not exactly as the EM, but almost at resistance as well. Almost. And this is the Shanghai Composite. So, not sure what we're seeing here initially. This looked like a very nice pennant and a possible breakdown. But now that we gapped higher, perhaps this is something else. This might be like a symmetrical triangle starting from, who knows? I mean, the problem with corrective moves is that they have so different possibilities of them unfolding that initially something that looks clearly like a pennant might end up being a triangle, might end up being something else, might end up being a complex correction of some kind, might even end up being a bottom information. I mean, for example, this might end up being like, I don't know, like a leading diagonal, and then you might see like a huge move higher. Who knows? I mean, so far it looks like a corrective move, but
what a shift in psychology in a week from wanting to be long the dollar, short the world, to wanting to be now it looks like you have to be long the world right now.
Yeah, but we
for a
need
while,
to give it we need to give it a little bit more time. Personally, as you know, I'm not a fan of the dollar. I believe that fundamentally speaking, in the medium to long term, the dollar is doomed to depreciate vastly from where we currently are. I'm not saying that's going to happen tomorrow. I'm not saying that's going to happen in a month, but I'm saying that given the fundamentals of the US economy at the moment, I see no way forward than a rapid depreciation of the dollar in the time ahead, which might be in a year from now, right? So what does that mean? Does that mean that I'm shorting the dollar in every opportunity I find? Absolutely not. I'm doing what the technical charts are doing. What it means, though, is that when the technical charts start showing me that the dollar has really shifted lower, I'm going to be feeling much more confident in pushing my positions, Coach. You understand what I mean?
Yeah,
because then I'm going to be feeling because then I'm going to be feeling that I'm also trading in the direction of the longer term trend. And, this is a very good feeling because you start by setting X objective, but instead of trying to take profits, you just start trailing your stop in your profit because you're thinking, I might have a rainfall, I might be starting to get like 1-2%, and I might get, 10%. So, let the position run, right?
Yeah, people are banding about like 20% declines in the dollar from wherever it peaks, which would take it back down to those lows around, the 88 level or so.
In my opinion, it might
Yeah,
even improve. Depends on what happens. It might even
75.
Improve,
I know guys looking for 50, Steve, in the Dixie.
eventually might be the case. Let's just say the following. The only thing that is holding the dollar, the US economy is an economy that is running during good times, triple deficits, all the kind of deficits that you can have in an economy that are currency negative. The US is running much higher than they should, especially given the fact that, we are under peaceful times and theoretically speaking, still during the expansionary phase of a business cycle. I don't want to even figure out what's going to happen during the next recession. And the only thing that's keeping a bid on the dollar is status as the world reserve currency. Now, nobody that has eyes can doubt that a slow move away from the dollar as the world reserve currency has started happening since the previous financial crisis. I guess you agree with that, coach, right? There is a slow shift out of the dollar. It's still slow. It's still at the very beginning, right? So if for some reason this accelerates, there is nothing that's going to be left holding the dollar this high. Nothing.
Well, I'll tell you, Putin and the Prince of Saudi Arabia were laughing together at G20. Yeah, and a lot of guys I talk to say that there could be a falling out with Saudi Arabia. That could be the end of if they start accepting payments in other currencies. That's the end of the petrodollar, and that would be another leg of the stool kicked out from the dollar.
Exactly, because don't forget that what I said.
Oil is mainly all priced in dollars.
Exactly.
Except for China has their, they started their energy exchange.
Many people don't understand that what it means having the world reserve currency is very correctly, as you put, is that for many kind of transactions, you first need to obtain dollars to go through them. So, the less that's the case, the less there's going to be the need to actually go through dollars to do something, right? So, that's what I was talking about when I said a slow shift out of the dollar. Of course, shifts like that are, of huge magnitude, so they don't happen overnight. They take years to unfold, but at some point, you might see an acceleration of that. Perhaps the period between, if we want to talk about it in terms of Elliott waves, perhaps the period between 2008 and now was a wave 1. You understand what I mean? And perhaps there is a wave 3 to follow. In shifting out of the dollar as the world reserve currency, right? So, let's see, because, all those are just theoretical conversation, because you can't trade on them, simply because the time horizon of things like that is huge. Very few people on the planet have the patience and the accounts to trade on long-term fundamental thesis. But regardless, I still consider it helpful to give a long-term picture, because it's always a good idea having the big picture in mind, even when you're just trading in the short term. That's what I think.
You had your VIX chart up there, Steve. If you pull up the weekly, you'll be able to see, I'm pretty sure with your moving averages, the weekly chart. That's daily, right? So if you go to weekly, you'll see where those moving averages come in. That's where I think we're going to, about 14.5, and that would be the second higher low So,
Yep.
I'm looking around 15, 14 and a half for vol buyers might be the area to start looking at. I don't think we should retrace all the way back down to 10.
If you remember when we had this spike higher in January, the first thing I said it was VIX in this business cycle, in my opinion, is never going back down here.
Yeah.
In this business cycle, and as you
it
see,
shouldn't go to 11 now either.
Yeah, very likely. And as you see, this time we bottomed at 10.50. And I still stand of that opinion. We're not going back to these kind of trading conditions again.
Right.
I think the genie is out of the bottle, and even if it takes some time and even new highs, I think that volatility more or less has picked up and is here to stay, which is something that I like as a trader, right? I mean, we had a couple of years that were horrible, because we had like zero volatility, and when stocks are just slowly grinding higher with like very low volume, unfortunately, it ends up affecting effects as well in an extent, right? So I do think that more interesting times are ahead in the months to follow. And since we have, 3 more minutes for your guest, I'll say that I also think that, being with ForexAnalytix is a good opportunity for you to, be at the right side of the markets more often than not. And since we haven't mentioned it today, also let me mention that if for some reason you're looking for, to change your broker, or if you're unsure that your broker is the proper one for the kind of trading you have, or even if it proves that your broker is the proper one that you should be on, you can still get rebates. So visit our reimbursement program, speak with Trent and Justin from Forest Park FX. They're an introductory broker, and they can help you get either your ForexAnalytix subscription subsidized or even
rebates.
Cashback. If you exactly.
Rebate. Hey, buddy, great job extending it out. Chris is in the house now.
Perfect.
So,
enjoy the interview, Coach.
Yeah, thanks very much, Steve. Great review of the board. It's my opinion that Steve does the best review of the board in the business every day. If you don't know what's going on, all you have to do is follow Steve for a half an hour. Hi, Chris. How are you? Welcome back to Face. We waited for you. So I'm going to make you the presenter. And I'm also now going to look for Ken, because I know you both have a presentation to make. You have the screen. Let me find Ken. Okay, Ken, I'm going to make you a panelist so you can enable your mic, and Chris, you could enable your mic. And we're going to be talking about Neuro Trader, not nervous breakdowns. So, hi, Chris, my trading warrior brother. How are you? And Ken, very nice to meet you. Welcome to Face, guys.
Thank you for having us. It's good to see you again. And my apologies. I looked at our conversation. I thought we had agreed to 9:30. So if I misunderstood, I totally apologize on that.
Oh, do you have a note from Mom?
Shoot, I'll go get one. Can you give me
all right. Anyway, glad you're here. A very interesting topic. Probably has something to do with NLP and measuring it on people. So, Ken, nice to meet you. And why don't you tell us what you're experimenting around with, Chris?
Okay, so Ken and I, through a mutual student, met several months ago. And very quickly, I realized that we both realized that we had to partner with each other. And what we're doing is we are building the world's first online hedge fund that uses biodata, AI, and wearable technology to not only mitigate risk, but increase peak performance in traders. And as you know, Dale, from your decades of experience, that trading, all the decisions that we're making, we're not athletes. We don't, throw a football. We have to make decisions. And those decisions are affected by both our biological and neurological states. You know, people
Agree,
have the
agree
experience.
100%. You know, it's almost like you have to be in like an athlete, Chris, a peak performing
Yes.
state. And if you're not, your decision making isn't as good. I had an example in my own trading last week. So, you know, you have a rough night, you don't sleep well, your decision making's not as clear. You may tend to say, oh, like I did with some gold positions, I'll just get out of the way. And there was no technical reason to get out of the way, but it was strictly emotional. So
Yeah, and keep in mind, you and I have been doing this for a long time. You a little bit more than I have, but the bottom line is, even with experience, we're going to experience these things, just like athletes experience performance anxiety. And the best athletes in the world, Tom Brady, Tiger Woods, they experience performance anxiety, and it's biological and physiological. And so we have kind of decide to move in the direction of using technology towards our advantage. There's a lot of technologies that are out there today that are being used by athletes at the highest levels. And you're starting to see big data come into sports. You're starting to see bio data and wearable technology come into like football in the US. For example, they now have sensors in the helmets to kind of determine what kind of impact, where it was, how much pressure that put on the brain. They're putting them in shoulder pads. They're starting to put them on football so they can measure spin rotation. And so you're seeing this in the highest echelons of competition and performance, that they're using technology and biodata to increase performance and measure performance. And if you're not measuring something, you can't manage it, you can't improve it. And so Ken and I are of the belief and of the approach that when we start to measure these things, we can actually start to find patterns in a trader's biology. We can find patterns in a trader's heart rate, in their skin conductance, in the perspiration, peripheral temperature of their body. And through AI being able to monitor this, we can start to isolate for individual traders whether they're in an optimal, suboptimal, or non-optimal state. And that can be used as a way to not only mitigate risk, so when they're in non-optimal states, they're not making trading decisions, but also when they're totally in the zone, that they can start loading up, they can increase risk, they can be more aggressive because they're on it in that moment. And so we're using the technology and the AI to be kind of a trading companion that's with you 24/7 every second when you are trading. It never tires, it never sleeps. And so it kind of becomes like a computerized version of you and I being able to give feedback to traders in real time. And so that is what we're doing here. And Ken and I have been training in this from both the same and different perspectives. And so Ken, if his audio is ready to go, I'd love for Ken to just say something about that real quick before we kind of show people what we're doing.
Yeah, Ken, your mic should be enabled. Let's see here.
It looks like he has self-muted right now, so.
Yeah, so there's a drop-down menu for you, Ken. Let's see if I could unmute you. I can't unmute you. You have to go to the drop-down menu on top and choose your.
All right. Well, how about while Ken, because Ken is on the road right now and he's probably on a mobile device. So while he's figuring that out, why don't I just kind of jump on in?
Okay.
And Ken, when you're ready.
Interesting, Chris. I've been.
All right, I got you. Yeah.
Okay, there's Ken. Hi, Ken. Nice to meet you.
And you too. So I wanted to say that 2 points. We've been researching this for 9 years. So we know that biology is a leading indicator of our performance in trading. So as Chris rightfully said, biology is a leading indicator of athletes, and they've known that for quite some time now, 20, 30 years now. The Russians were actually at the forefront of all this back in the 60s and 70s with their space program. But in trading terms, we've been doing this for 9 years now. And I want to go to your earliest point in the introduction. When you said about that you had a bad trading day yesterday, you knew you hadn't slept well, the emotional side. And so the question in that entire sentence is, how do you know? Where is the threshold where you should trade, and where is the threshold that you actually need to sit this one out? That's the question. When we leave it to our subjective experience, we can sit there and turn around and say, yeah, I didn't have the best sleep last night. I got a little bit of a runny nose, but I think I'll be okay, and I'll just soldier through this trading day. And trading's not that type of a profession that you can actually do that. And as Chris said, the most extraordinary thing, and Chris will show some slides a little later, the profound difference, and it really is a profound difference, and all of you will be able to see the difference between a peak state and a suboptimal state, a winning trade and a losing trade. So again, we go back to this point of when you're trading, it's really true in trading about a penny saved is a penny earned, right? To not trade, to not take a position is just as important a skill to learn as taking a winning trade. It's this because it's the same decision.
Well, not only that, even though it doesn't show up in the P&L of avoiding a bad trade, it's very important when you measure performance. So avoiding bad trades is almost or as important as being in successful trades.
Coach,
it's totally
in my
making money.
opinion.
Coach, if I may ask something.
Sorry.
Go ahead, Steve. Steve has a question for you guys.
Because we're talking about biology. If you want to start by biological traits, and condition, from what I understand, we're talking about condition. Yeah, I understand that it plays a role, but if you want to go all the way, shouldn't you start by throwing people an IQ test? That's the basis of their biology, isn't it?
No, an IQ test, no, not really, because then so just as a lead, my wife is a clinical psychologist. We've been working with a peak performance psychologist for 4 years now. So IQ tests, there's not just one standard IQ test. That's the first thing. So the question my wife would say is, which IQ test are you talking about? So again, it's not quantified. It's also subjective because it depends on what person wrote the IQ test. The other thing in terms of IQ test is I can do an IQ test today and have an extraordinary result, and next week I can have a really, really bad result because something fundamentally has gone down in decreased in my life. You know what I mean? So, and then you can be, have had a child and be euphoric and also really fail on your IQ test simply because you can't concentrate. That's not the point. IQ tests are not biologically, they're more a assessment of your cognitive functioning. But when we talk about biology, we're talking about the central nervous system. And
Steve believes in IQ tests because he's a Mensa.
It's good. If I was a Mensa, I might be using that on my credentials as well. So,
all right, go ahead.
People with very low IQs can make exceptional traders. And Dr. Tharp did this 20, 30 years ago. He back in the day, he was calling it street smarts. There's a lot of people with a lot of PhDs who cannot outtrade what they would call a simpleton, who simply trades with his gut and believes in his own self-processing of information and acts without performance anxiety.
I agree with that.
I agree. The IQ doesn't have much to do with anything. IQ is excellent if you want to be able to explain intellectual concepts, but in terms of trading, of having the courage or the guts to get in and get out, to take a hit and still come back, to have the grit to come back, doesn't have so much to do with classical IQ. It has more to do with an emotional intelligence and an intuitive knowledge to be able to discern between good and bad opportunities.
And skills as well.
I agree with that. With the only minor disagreement being, it also depends on the kind of trading you want to do, because some types of trading are more elaborate, and some basic, some minimum, let's say, IQ would be required because all the rest wouldn't really matter. But yeah, I agree with you. I mean, if you possess, from an IQ level and above, which isn't like anything like great. Other characteristics, which are mostly psychological, do play a very key role.
Yes. Because at the end of the day, we trade to make money. So we can look at that in terms of success. We can look at any field of endeavor and turn around and say, what are the qualifying things of being successful? sports people who Cristiano Ronaldo, who's on, hundreds of millions of dollars a year, is not going to have an exceptional IQ. And there's different forms of intelligence. So we should really, to be fair to everyone on the planet, successful and unsuccessful people, we really should look in terms of the biology. And biology is very, very, it's an even playing field. We all have a homeostatic temperature of 36.7 degrees Celsius. There's certain things that we all share, and it's these metrics that we can use to start to recognize when someone is moving into a threatening and a non-threatening situation, simply because the nervous system responds that way. Whether you have an exceptional IQ and you're part of Mensa or you don't, you're still going to, your nervous system is still going to respond the same thing in terms of a threatening situation. You're going to want to walk away from it. Same as when you're walking into a bad trade. When you're in a bad trade, you're in a threatening environment. Biologically, your central nervous system will respond exactly the same, regardless of race, color, creed, and intellect.
Interesting.
And that's where this
Great question, Steve.
This is where it equalizes everybody. It gives every single retail trader the same opportunity to trade up and against the guy from Goldman Sachs who's on $2.5 million.
How about compared to algos, where you don't have to worry about any emotional response, peak performance? How about just a machine? Is that where the goal of where you're trying to get to, eliminate all the times that people aren't machines and have them trade when they're performing like one?
Absolutely. So we use technology performance not to make humans redundant. A man with the assistance of technology will always be technology in and of itself. In addition to that, it gives back people and everybody else that spice of life. Everybody likes watching Roger Federer play tennis, Cristiano Ronaldo, Tom Brady. We enjoy seeing people at their peak because we want to be at a peak ourselves. Everybody has this deep desire to perform at a peak level. No one's going to watch two robots playing tennis. Who cares? There's no emotion in it. There's no thrill. There's no excitement. And being able to give retail traders the same technology, the same support, the same education, the same skill set for them to walk in every single day, whether you're trading for 30 minutes or an hour or for 4 hours a day, 1 day a week or 5 days a week, but to get you into that peak state and give you the support for you to be a professional athlete in the game of trading. That's what everybody wants. That's what juices people up to be able to trade again another day and to make money.
Okay. So are you going to get into the process and the equipment?
Yes.
Okay.
Ken, do you want to just briefly kind of cover how, what we're trying to communicate in this slide, and then we can kind of show some examples of winning and losing trades and the differences in the biodata?
Yeah, so we have a wearable device. It fits around your finger. It measures your heart rate, your peripheral temperature, and your perspiration, your skin conductivity. Via Bluetooth, that data is moved to your PC. Our software at the PC takes that information in, shoots it up to the server. The machine learning, the artificial intelligence, correlates that with price and market sentiment and can automatically take trades in and of itself or alert you of when you're in an optimal or a suboptimal state. And that gets fed back to you. At the end of every single day, we provide reports in terms of your performance, in terms of your biological performance correlated with your trading results. So there's two things that we do. We increase your self-regulatory capabilities. That means we train you using wearable technology to enter into peak states quicker and be able to hold that peak state, so being in the zone longer. Wearable technology has the extraordinary ability to decrease the learning period that it takes for someone to learn how to get into a peak state. That's what wearable technology does exceptionally. In addition to that, it monitors you in order to be able to recognize when you're in or out of a suboptimal state, therefore telling you when to trade and when not to trade. So that's the system in a nutshell.
Okay.
And we have some, so we like to show you some examples here as well about, increasing the self-regulatory capacities and showing the differences in the bio data here. So we have a couple slides here, and basically, so the top end of this chart, what you're seeing here is the price section on the Euro USD, and these are two separate trades, and we're showing you the differences in the bio data between a professional trader and a beginning trader. And so, Ken, do you want to briefly comment and talk about the differences in the bio data there?
Yeah, so on the left-hand side, as Chris said, there's the Euro USD, and you can see it's a very, very low volatility, and underneath is the heart rate, and you can see how erratic the heart rate is of a beginning trader. He's constantly second-guessing himself, which is a reflection of his heart rate. He's very, very nervous. Should I buy? Should I sell? He's constantly asking himself, what is this? What does the price mean now? What does this tick up, tick down mean? And this is reflected in the heart rate. On the right-hand side, you see a lot more volatility in Euro USD, and you can see what the heart rate's like on a professional trade. It doesn't change. And so that shows composure.
I'm glad that's not an EKG.
So that shows,
You know what I mean?
Might be
Ken?
the end of us.
That's what I mean. Yeah, you can never be in a peak performing state again. But yeah, that's really interesting. So that's a type of ideal performing state that your heart rate stays in kind of a defined range here. Is that what you're looking for? Okay.
And
so
it's rhythm.
heart rate coherence. Yeah, it's called heart rate coherence. It's when your breath rate and your heart rate are in unison. So your two major organs in your body are actually in rhythm, which all of a sudden what that produces is a quiet mind. Your mind slows down because your body is not in disequilibrium. So the more you move on a scale from equilibrium to disequilibrium, the more you move into disequilibrium, right? The more you are talking in your mind and the different types of words they use. So if we go into a state of complete disequilibrium, which is being totally angry, obviously you're going yelling and screaming in your head and actually and verbally, right? And so when you go down the other side of the spectrum, and that's where your heart rate is extraordinary, people get heart attacks that way. Your peripheral temperature is different, your skin conductance is different, your muscle tension is totally different. That's when you're clenching your fist, you're clenching your jaw, all these sorts of things start to occur. Really bad time to take, as an extreme, really bad time to take a trade. On the other side of the spectrum, you have this sort of a heart rate, and you have you don't have muscle tension. You have a very, very calm, relaxed, psychophysiological state. That means your muscles are relaxed, your blood flow is excellent, you're getting the right amount of oxygen mix and carbon dioxide mix to your brain, your executive functioning is fantastic. The thing that people don't know, the subtleties are that your hearing improves, your vision improves, and therefore you can perceive the market with less doubt, self-doubt, and with less questions. You start to perceive reality with a lot less noise, right? So people talk about not looking at the noise in the market. We need to get rid of the noise in our head. There's no noise in the market. It's the noise that we create in our head.
It's all in our head.
In the market, But this is the way that biologically we can see that threshold. Where is it that this guy's biology starts to produce losing trades? When is it that the probability of losing trades increases? Where's that threshold? And where's the threshold where there's a higher likelihood that the trades are going to be successful? This is what our biology allows us to do.
And there's a couple things I would like to just point out here real quickly. So on the left side, his heart rate is getting up to 100 beats a minute. That's a relative panic state. Anything, 100, 120 is a total red zone. Whereas here, it's consistently between 60 and 80. And you see this one little subtle spike here. This is right before they pull the trigger. So we actually had a biomarker communicating to us ahead of time, hey, they're about to pull the trigger in the market. So in other words, the bio data that we're seeing here isn't just showing the extremes, the consistency, or the volatility, it's also communicating to us ahead of time when a person is most likely going to make a trade, because we all experience a certain kind of anticipation. We all experience a certain level of excitement. There's also your brain is going to light up when you start to recognize a pattern in the market and you start to see, oh, I know what this is. This is going to start to reverse. I need to buy here. Those are going to create neurological and biological markers that we can actually pick up ahead of time. So the AI and the data that we're monitoring is not only telling us what's happening as they make actions, but it's also even giving us clues ahead of time. Hey, trader A here is most likely going to make a trade in the next few seconds or minutes.
Okay,
So,
and if they're not in a peak performing state, erratic heartbeat, is it your aim to have people know and know that they probably shouldn't be trading because they're not in the zone? Or do you notify traders that, you know, we see this spike, you're getting ready to pull the trigger, but your heart rate is too erratic?
Yes. So there's two types of regulatory capacities within.
You wouldn't stop me, man.
You know, the lovely thing that we do is that we allow the person to trade with their own volition. Press the buy and sell buttons as much as you want. But in the background, NeuroTrader is actually doing its own trades based upon your biology. And more often than not, NeuroTrader will beat the trader every single time.
Okay.
So in other words, NeuroTrader can be trading a separate account. So you trade your account, and then NeuroTrader is kind of trading a mirror account, except what it's going to be doing is saying, okay, you just bought the US dollar, but based on our analysis of your biodata, you tend to make really bad decisions in this biological state. We're not going to make this trade. But then you make another trade, and it's in a good biological state, and it's saying, oh yeah, this person under this state tends to make really good trading decisions. We're not only going to make that trade, maybe we'll even increase the risk on our side. So there's now two opportunities to make money.
Mm-hmm. Okay, so very interesting technology. Do people have to come out to you one-on-one, face-to-face training to do this, Chris and Ken, or can you do it remotely? How do people? Okay, here we go. You're prepared for my next question. Go ahead.
No, you led Chris, so Ken, go ahead.
I just was going to add, I think Chris said to me the other day that we have traders in over 30 countries now.
How many?
So, yeah, you don't have to come to us. This can all be done online. We have people that basically we send the technology to the traders, and they, integrate with it. They test it out. They build their baseline. And then, that's the first thing is the integration part about this. So, Ken, do you want to just talk about this real briefly, the first, second, and third stage?
Well, yeah, so there's, as we said before, there's four parts to the thing. The hardware, which we send out, as Chris said, the software, which you download, the education, which is online. And because of this technology, we can monitor you remotely. It doesn't matter where you are in the world.
Yeah,
we know.
And what you're using, nurses use that when you go into a doctor's office. They put that thing on your index finger.
Very similar.
Same thing, right?
Very similar. Depending on what device it is, but yes, that device is primarily for the heart rate. It's volume pulse indicator.
Okay.
But it's based on the same thing. This is our device is a medical grade device. Its sampling rate is like up to 900 pieces of data per second. So it's extraordinary clarity in terms of the biodata that we're able to pick up. So once we integrate a person over the course of the next 6 months, over the course of the first 6 months, we create a baseline for this person and we start to develop these, what we call an individual peak performance profile for the trader. We know, we start to track what is your biology in a losing trade, what is your biology in a winning trade, and everything in between. And based upon that data, that's how we start to build the repository for the artificial intelligence to get all the more acute and to start to recognize, well, this is maybe a trade that you shouldn't take, where the room for error is very, very slim. And we can actually start to save money on these very, very, very tight trades where maybe you would have taken it and lost, but because of the more data we put in there, the greater the granularity of the outcome that we can get, and all of a sudden we can start to produce very, very excellent trades just simply based on biodata. From that, with the 100 traders that we have commencing the program in February, we're going to start to allocate assets to those guys. Again, it's a gradual thing. Some people learn faster. Some people take a little bit longer to become consistent peak performers. And as these guys come online, we're going to be allocating them assets and suggesting to them strongly what assets they should be trading, so that we can really create a well-balanced fund, a well-balanced portfolio of traders and assets that we're following. So
and keep in mind here, so if let's say a trader is trading on their own, they're at their home, whatever, and so by and large, I mean, they have to do a lot of decisions and a lot of managing of things on their own. They have to decide what instruments, they have to decide what times of the day, what days of the week, what kind of risk parameters and everything like that. We take that away completely so that they just have to find patterns in the market and trade it. We use the data, the bio data, the AI to kind of understand, hey, you don't do so well in these days at these times. You do really good with these types of volatility instruments, and these types of instruments with this kind of volatility, you don't do well. So traders now have to kind of measure that and manage that on their own. And we're saying, no, we're going to treat you like Tom Brady. Tom Brady doesn't have to decide what uniform he's wearing that day. That's decided for him. He doesn't have to decide, the playbook. That's what the coaches do. He just has to show up and throw the football and read the defense and make the plays. And that's what we're turning traders in. We're saying, look, we don't want you to be a Formula One driver who has to be the mechanic and the guy who changes the tires at the same time. That's just not going to work. We just want you to drive.
Most traders don't succeed because they split their intellectual energy on far too many jobs, and you can't focus on the one thing you're supposed to do, which is enter and exit a trade successfully.
How about this, guys? How about too many instruments? I use the example that guys I knew early in my career on the trading floor may have been a local in cattle, and they never had to go to another market to be successful.
Mm-hmm. And you want to specialize. Can you imagine going to your heart surgeon who's also got a lawn mowing business and also is a panel beater at the same time? Like, would you really trust this guy if he wasn't a specialist? Much the same way. This is why most traders don't have confidence in themselves. You can't trust yourself. Why? Because you're a jack of all trades.
Okay.
And the key here, Dale, when you said that in terms of too many instruments, the real question is how many is too many instruments for that trader? Everybody's going to be different. There are certain traders that, so like, for example, I know a guy that all he does is trade the S&P E-minis all day, and that's it. And he's fantastic at it. And he has a tremendous amount of skills in terms of recognizing patterns in the market. If we were to throw him other instruments, he would do miserable. But then other traders sometimes do better when they're across multiple asset classes. So the real question for traders has always been, how do I know which instruments and how many is too much for me and how many is too little? Now we have technology that can kind of measure this and say, look, when you start expanding to 6 instruments or 10 instruments or this, your performance drops. But when you just trade these right here, you do well. With my students, I analyze their accounts. So after they complete 100 trades with us, I do an analytics session with them. And I analyze all the instruments that they're trading. And more often than not, students are trading too many instruments, and we have to remove the underperformers. Once we remove the underperformers, their performance changes dramatically. Like, I've seen 10 and 12% shifts per annum just by changing the instruments that they trade. So the real question is becoming how many and what are the ones you should and should not be trading. And now we have technology that can help with that.
Yeah, I've heard that if you can't remember the last price of the instruments you trade, you're trading too many.
That's a pretty good example. You have to know them inside and out. So I agree with you on that.
Okay.
We actually worked with a product which actually tracked and measured your ability to one of the terms, it's an incorrect term, but cognitive load. How much information processing speed, how much information can you actually hold and process at that one point in time? And it's extraordinarily shocking and humbling to see how much little information you actually can hold effectively. So it's not about knowing a lot of things. The point is, in terms of quality,
recall.
How much information can you qualitatively remember without starting to have the lines blur and not really know what decision goes where? And this is that point.
So, let me ask you guys, are you, stage 3, institutional onboarding? Okay, go ahead.
So at this point in the process, we have all the baselines for the traders. We have, we understand their portfolio and what assets that they will perform best in and which ones they'll perform suboptimally in. So we now have really filtered out and really honed in and narrowed down, hey, this is where you will outperform in these particular areas and these particular instruments, times, days, everything. At that point, we have a lot of relationships with various institutions. So now at this point, we can start connecting institutional capital with the actual trader. Keep in mind, we're also going to be funding traders ourselves that go through this program. So, a lot of traders come to me and like, look, I've shown that I can make money, but I only got, $5,000 in a bank account. And unless I can, multiply that by 10 plus per year, I'm not going to pay my bills. I'm not going to pay my mortgage. I can't live off that. So what do I do if I don't have the capital? And we say, don't worry about it. We have the capital ourselves and we have access to capital. So we kind of eliminate one of the biggest hurdles.
So you're kind of helping people become prop traders with your technology.
Correct. We are creating a fund. We are creating an online fund where people can trade from home and they don't have to worry about capital. We'll cover the capital. We'll cover the technology. We'll cover the portfolio. How much of a
drawdown will you tolerate with your technology?
So we talked about this, and we generally only want our maximum drawdown would be a 1 double-digit month. If they go beyond that, the numbers are pretty clear to us that once a trader within a single year, calendar year, has 2 double-digit drawdowns, their chances of recovering that account, that's just getting back to break even. Their chances of recovering the account are about like 3%.
Okay.
And so the numbers are very clear. And so we are very cautious about that because if you think about it, if you have a 20% drawdown, you need what, a 30% return just to get back to break even.
Right.
Hedge funds close after a certain percentage drawdown because they know, shoot,
they're not going to hit their high watermark again. Yeah.
Yeah, exactly. So, that for us, the statistics are pretty clear. You get maximum of 1 double-digit drawdown. After that, it's just too much. Your chances of recovering are slim. So risk is super important for us.
Okay, reasonable. Any other slides, or do you want to talk about the cost of the program, or leave that for when people get a hold of you?
No, we just have a few more slides here, super brief, just to kind of answer some questions. So people are wanting to know, how do we join this? And so we have 3 tiers of the program. We have a developing tier, we have an intermediate tier, and we have a professional tier. The first 2 are 6 months, and the third one is 12 months. And basically, they're broken down into the developing tiers for someone who's probably pretty new to trading. They don't have a lot of experience, and they feel like, look, I want to do this. I'm not sure if I want to be like a professional who sits there for 8 hours a day and do this, but I want to do this. And I want to have this kind of feedback and models and technology available to me so that when I'm trading in the most optimal states possible. So they only have to complete any one of these tiers. The second tier is you're going to get a lot more feedback from us on a much more regular basis. In terms of the bio data, they're going to get a lot more coaching from us on a regular basis. And so this is kind of the mid-level tier. This is somebody who's been doing this for a couple of years. They're like, yes, I want to be a trader. I want to do this, and I want to make sure that I'm always performing in my most optimal state. And then there's the professional grade, which is, look, this is what I'm committing to 110%. There's nothing else I want to do. I have the time. I have some resources to do this, and I want to get feedback from you guys every single day. So those are the 3 tiers that we have. So first thing is they have to complete any tier of the program. This is a pretty low bar. They only have to, on demo or live, achieve 1% profitability over that 6-month period while not violating the risk parameters. So not just, it doesn't have to even be live. It can be on a demo account. And then the third criteria is we're looking for consistent behavioral profiles. So are they trading the same instruments? Is their risk management consistent? Are they trading the same times of the day? Are they trading the same types of patterns and setups? Because that will show in their trading and in the decisions that they make and in their behavioral profiles. We'll see that. And then again, the last criteria is no more than 1 month of double-digit drawdowns. That's the requirements to join our hedge fund, which is a pretty low bar.
And we understand that most traders out there are not consistent, right? They're not consistent even in losing, let alone being consistent when in trading successfully. The point of the 6 months is in order to start to train these people as professional traders, to give them that time and the technology and the support to train up these guys from being inconsistent to being consistently losing, to be consistently break even. And then once at break even, as we've said a number of times, Chris and I, out of 10 trades, if we take away 2 losers, we can automatically move someone who is break even into a profitable position. This is why the bar's so low. It's because of our ability to mitigate grossly losing trades in advance, which actually pushes someone into the field of being profitable.
And Dale, you've known that sometimes the difference, between a winning month and a losing month is really it's not necessarily making more wins. It's sometimes just making a few less losses.
Exactly.
It's often a very fine line.
It's always a fine line. Would have, could have, should have, right? So,
and these numbers have changed. We should probably, I actually haven't updated this. So we actually only have, I think 7 seats left for tier 3. We have about 10 for tier 2, and we only have like 7 or 8 more for tier 1. This changed since the last 2 weeks. We've had a lot of people sign up. So,
well, congratulations, Chris. Ken, nice to meet you. Very interesting take on a way to help traders improve by looking at what Mother Nature put together that in all of us as men and women that we have to overcome to be effective traders. So I wish you guys a lot of success with your new program.
We appreciate it. And we want to just say it's always great to be on here, Dale. So Ken, I don't know if you know, but Dale and I lived in the same state of Chicago. He was a floor trader on the CME. And he's not only what he calls me his trading warrior brother, but he's also a spiritual warrior like ourselves. If you follow him on his Twitter, he's a really serious spiritual practitioner, and he's just bringing a lot of goodness into this world. You can see it in his Twitter, and he's built a wonderful community. And it's just if we had more people like Dale in this world, in the trading community, it would be a much better community. So we just want to say thank you for that.
Wow, thanks, Chris. And Ken, nice to meet you. Like it or not, you're now my trading warrior brother. Well, and, I wish you guys a great holiday season and a great new year. And maybe we'll get together a little bit down the line and, your program will be further along and see how things are progressing for both of you. So thank you very much for your presentation today, Chris, Capri, and Ken. Thank you very much.
Wonderful.
We appreciate it, Dale. Thank you.
Okay, good hunting. And everyone, remember, don't just count your pips, count your blessings. See everyone around for Turnaround Tuesday tomorrow. And that's a wrap for Face today. Adios. Enjoy the rest of your day. Don't forget to smell the roses. Money comes and goes. Time is gone forever. Make it count. I'll see you guys later.
Be well.